Hi, Ira Coiner here, President and founder of Triathlon Partners. Thank you very much for watching this episode of Triathlon TV. We will be discussing estate planning. I find this a very interesting topic. It's very pertinent right now, but there's a lot to cover, so this is going to be episode 1 of 2. So let's go into why I think this is very important now. Well, the current exemptions on your estate tax, meaning any value of your estate over this amount will get taxed at 40% estate tax. It's different from income tax. It's different than capital gains tax. It's $14 million for a single person and $28 million for a couple. Now, these limits sunset in 16 months, December 31st, 2025. And we revert to the old levels, which are about half of what the current levels are. They go to $7 million for an individual, $14 million for a couple. Now, this is going to affect a lot of people. It's going to affect those who've already done a lot of planning for their estate. They were below the 28 level, but now they were above 14, so they're now caught with all of a sudden there's a lot of planning to do, right? Then we have those that are younger. They're not in retirement. They're not thinking about it. And this lower threshold of 7 million is well within the target of where they're going to be when their estate becomes something of pertinency and something that they want to take a look at. So it's best to look at that now. And many people don't think, hey, $7 million, I don't know, $14 million is a couple, I don't know. Well, I'm going to tell you some tricks we use in our financial planning business to rationalize why this number is really a lot closer to in your grasp than you might think. Now, we use something called the Rule of 72, and I'll post a link of an article that we wrote about it. It's very good. It's very simple as well. Now, when you take the number 72 and you divide it by the average return you think you're going to get on your investments every year, that number is how long it will take to double, right? So let's say you think your assets will earn 7.2% a year. Now, it's not unrealistic. The stock market's been averaging 8.5% a year. The NASDAQ's even higher, but we'll just do 7.5% because when we take 7.2%, excuse me, because when we take 72 and divide it by 7.2, we get 10. So every 10 years, your money should double, right? So let's go with someone who's 45 years old. At 45, when they get to 55, their money will double, right? When they get to 65, their number will double again. That's 2 doubles. When it gets to 75, that's 3 doublings, and 85, 4 doublings, right? So that's not 4 times what you've invested now. That's because when you double something once, you get twice as much money. When you double 2, you have 4 times as much. When you double 4, you have 8 times as much. And when you double 8, you have 16 times as much. It's a lot more money. And all of a sudden, that $14 million threshold on the top is a lot closer than you think, right? You're going to have a lot of these people going to have great wage growth, just go up and up. They might get an inheritance, and they might be earning more than 7.2% a year. So this is something that's really going to affect a lot more people than they think. So part of our financial planning business is we assist clients to maximize their estate value as well as the amount of value and assets that they're able to pass on to beneficiaries. Now, how do we do that? Well, we do that by taking things out of your estate, right? When you take things out of your estate, those things cannot be subject to estate tax no matter how large they are, right? There are some downsides, but with proper planning, those can be mitigated and not really be an issue, right? But we also have to decide, what do we keep in your estate and what do we take out of your estate? A lot of these things matter because of tax implications, because not everything is treated equally in the tax world. And that really does matter when you're looking to maximize the amount of wealth that you're going to pass on. Now, we'll go into those topics in the next episode, but we do want to remind you that when you're planning your estate, you should be talking to an estate attorney, right? They have to draft a lot of documents. They got to make sure they're correct because we're really talking about a lot of money. Because if you have money in your estate that goes above that threshold, 40% of it is going to go to the government. That's an awful lot, right? So from that standpoint, we thank you very much for tuning in. We hope that this was a very strong foundation for your first lesson in estate planning and that you're going to tune in to our second episode. We go into a lot more detail, as well as, as part of our firm's mantra and belief that our role to clients is to engage, educate, and empower them so that they're able to make a confident decision that best meets their objectives. So thank you very much for joining. Have yourself a wonderful and blessed day. And please stay tuned to watch the disclaimer, right? The disclaimer, we've got to watch the disclaimer, right? So take care and hope to see you in the next episode. Bye.